Hello everybody, this is Chuck Carnival, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In my recent article titled Diversifying by Sector, 20 High-Quality Attractive Dividend Growth Stocks Rated A or Better, I actually only covered 11 of the 20 stocks in the video because obviously for the sake of the length of the video. So at the request of several subscribers, I'm going to go ahead and do this addendum video where I cover the remaining 9 companies that were originally listed in this portfolio. And I've redone it, so I've made just the 9 remainers. You can see my previous video and see the other 11 stocks that I actually did cover. So I'm going to start here by looking at Nucor, which is a company in the material sector. And one of the things about Nucor and about companies in the material sector, as I kind of indicated, it's a very cyclical sector. It's very hard to find value. Now, this company does have a good long-term dividend record, but it's not as good as, as the numbers themselves maybe meet the eye. It is a company that has a very long streak of raising its dividend. And I want you to notice back in the late 99s up through, let's say 2009, they were raising their dividend very generously and with very high rates. But then coming into the Great Recession, the rate of dividend increases began to slow down. And really from 2011 to current, they've raised the dividend by about a penny a year, or just barely. So their long-term dividend growth record looks pretty good. But if I shorten the time frame and look at its more recent time frame, they've only been increasing their dividend by 1%. So you can see why I didn't include this in the regular article. I find a company like this too cyclical for me. Although it technically has a great streak of dividend increases, obviously the streak is a little bit iffy when you consider the rate of change. And then as I look at dividend growth stocks, I look at things like free cash flow and operating cash flow, like I talked about in the other video, and I like to see free cash flow comfortably covering the dividend. And frankly, that's not the case here with Nucor, which is obviously in the steel industry, which is a very, very cyclical industry. But anyway, here is one that I did not include in my original video, Nucor. The second company I will cover is Eaton Corporation. It's in the electrical components and equipment industry. Not quite as cyclical as what we just saw with Nucor. This is an industrial. And as I mentioned in my first video, industrials also have a certain amount of cyclicality. We don't have quite as much as we just saw with Nucor, but you can see periods where, especially during recessions, where the company's earnings do get very weak, but they have moderate cyclicality during other periods of time as well. But nevertheless, it has a good long-term record, grew earnings at 6.8%. When I put monthly closing stock prices on the graph, you can see that prices definitely track earnings very closely in this example. They've got a good dividend record. Their dividend increases have averaged over 9%, but there have been periods where the company has frozen the dividend, which again is an attribute of a cyclical company. But I believe the stock is attractively valued today. PE ratio is 14.1. That's blended PE ratio. It does offer a nice 3.6% current dividend yield. It's A- rated and only has 28% debt on the balance sheet. This is a company that I think does offer a decent opportunity to earn double-digit returns going out over the next couple of years. The longer-term trend line growth rate is slightly lower at 9%. And again, this is trend line where I'm growing each year's earnings by precisely this 9.25%. But anyway, it would still, for a 3 to 5 year period, assuming these estimates were correct, it would provide the opportunity to generate about a 12.5% rate of return. The analyst scorecard is kind of interesting considering that this company is cyclical. Its 1 year forward forecast is pretty good with about an 80% hit rate. However, its 2 year forecast, they've missed 60% of the time. And you can see that and see the magnitude of the risk. This is only over the last 5 years. So when you're dealing with a cyclical like this, I think you have to be cautious not to put too much credence in the forecast. But on the other hand, if you're willing to hold a company like this long run, it is a great company with great fundamental attributes. My next example sticks with the industrial sector. We're going to look at General Dynamics, A+ rated, 25% debt. Of course, aerospace and defense, and I've talked about this in a recent video not too long ago, and I pointed out that and Lockheed Martin would look like this, several of the companies in this sector looked like this. When there was some question on defense spending, these companies were trading at very low PE ratios, and that lasted for several years. And again, moderate cyclicality here, less than we just saw with Eaton. I'll go ahead and take the price off. You know, they did pretty well through the recession of '01, actually did pretty well during the Great Recession, had a down year in 2012, fiscal 2012, but otherwise their earnings growth rate has averaged almost 11% a year, and the stock price has tracked that. When it gets disconnected, if you're patient, it eventually reverts back to the mean. I wrote about this when I talked about it being overvalued, and of course you can see a reversion to the mean. It's come back to being very close to fair value. Now, the orange line on a graph like this, by the way, represents the midpoint, if you will, of fair value. But when you look at it from a forecasting point of view, these orange lines would represent valuation corridors. My preferred corridor is, of course, anything on these two lower lines or below if I believe the earnings are good. But even on these upper two, this would be high value. I would call this fully valued. So it's kind of in the, it's a little above the midpoint of fair value here. But regardless, it does offer some decent rate of returns. And if you looked at it from a normal multiple point of view, it could very easily approach 9.5% to 10% annualized rate of returns if you bought General Dynamics today. Its dividend yield is currently 2%. It has a very excellent dividend growth record averaging over 11%. So I think this is another candidate that you might want to consider. Again, sticking with the industrial sector, which I found, obviously several companies in this category. I'm going to take a look at SnapOn Incorporated, SnapOn Tools. Once again, you see a very nice correlation of price to earnings. You see very clear evidence when the price gets above the earnings line, it reverts to the mean eventually. On the other hand, when the price gets below the orange line, which it rarely has, at least over this time frame, it also reverts back to the mean. The stock got overvalued up into the late part of 2015, and then we had a lot of volatility, but really a flat line. The stock price really didn't go go anywhere for this period here. I've got it measured as a negative, but you could call it it was a flat line. It's now come into fair value. I think it's attractively valued at this level, forecast to grow at about 10% a year, which does mean it can produce some strong double-digit returns, mid to high double-digit returns going forward. The long-term forecast is 11% growth, which would also indicate, double-digit returns in excess of 10% a year, 13% a year actually going forward. The company has very little debt. It's A- rated. This is another one that I think you might want to consider if you're looking to build a dividend growth portfolio for total return. My final candidate in the industrial sector would be Stanley Black & Decker. Again, industrial machinery, also tools. Again, a very nice correlation between price and earnings. Did have some stress going through the Great Recession, and you can see the price followed the dropping earnings. The dividend record of this particular company is excellent, average growth about 6% a year, and it's even been maintaining that here in more recent years. When you look at it coming out of the Great Recession, its earnings growth rate has been, stellar, averaging almost 9% a year. If I shorten it some more, it's actually been 9.5% a year. You can see the stock got overvalued. This is the classic example in my opinion. And then we've had this recent reversion to the mean. It's starting to look like it's moving on the uptick again. Again, it's within these valuation corridors. I think this is another one that offers a good solid rate of return for a high quality A-rated company with only 23% debt. The PE ratio is 16. That's moderately high for me, but not real high. Again, it's on the what I'll call the fully valued level, not being overvalued. Anyway, you might want to take a look at Stanley Black & Decker at these levels. Ameriprise Financial is another financial stock that I didn't show. I showcased BlackRock in the previous. Ameriprise, you can see again a very high correlation between price and earnings. Undervaluation periods always lead to good performance. I consider the company undervalued today with a PE of only 9.1, dividend yield of 2.8%. Forecast growth going forward is actually exceptional, and if this company were to trade at a normal sub 15 PE of only 14, the rates of return would be extraordinary. Financials are not necessarily in favor today, but this is one that you might want to take a look at. My next example is also a financial, Prudential Financial, life and health insurance. A couple of things about this that I think are interesting. Coming into the Great Recession, it was a financial, and financials were pretty popular. The major banks were, etc. And it didn't participate to the extent that, some of the big money center banks did. But you can see we had this tremendous earnings drop. We had a 63% drop in earnings from fiscal year 07 to 08. And of course, the stock price followed that. And actually, it was priced quite rationally. But since we've come out of the recession, a couple of things have happened that I think are important to note. This used to be a solid 14, 15 times earnings company. But if I look at it more recently, in more recent years, I want you to notice that its normal PE has only been about 9. In other words, the market has not been willing to value this stock as highly as it once did. So in a case like this, I'm not really too concerned about the orange line. I'm really concerned about the blue line, because from a prudence point of view, this seems to be around a 10 PE, more or less. 9.3 is what this blue line actually calculates at, is a kind of a good average for Prudential. So when I'm looking at forecasting here, I'm going to go to the normal multiple, and I'm going to use one of these 9 multiples. I can choose from here, and I can be more conservative and say pick the 9.3 or maybe even the 9.5 instead of the 9.7. But regardless of which one I pick, I can then run my calculations. And even at these lower multiples, if the company doesn't get, if it gets a 15 multiple, and I can only go as high as 14 here, the annualized rate of returns would be exceptional. But even at only a 9 or 10 multiple, we've got double-digit return potential. The company only has 21% debt, and it's A-rated. I think Prudential ought to be looked at because it's selling at a discount to even its more normal low discounted PE ratio that the market typically applies. My next example is Carnival Cruise Lines. It's in the consumer discretionary sector. Kind of interesting to look at this company, if you will. It operated with moderate cyclicality. I wouldn't call this great operating history back here. If you look at what happened from 99 up into the Great Recession, it had some decent earnings growth. In fact, we can actually go back there, if you will, and calculate what that growth rate actually was. It had grown about 8.5%. When I put monthly closing prices, here was obviously overvaluation relative to that growth. Overvaluation again, we keep getting these reversions to the mean where you had, optimum times to buy the stock. But then as we move on here, you can see that coming into the Great Recession, they completely eliminated their dividend. Their earnings did drop rather significantly in 09, moderately in 08, but then they reinstituted a dividend in 2010. And since that time, the company's performed okay. We had some down earnings going through 2013 and then a recovery, but with only a PE of 13.8 and a 3.4% dividend yield, A- rated, with only 20% debt to capital, this looks like an intriguing investment. There's obviously a lot of things to consider when you're looking at the cruise ships, but forecast growth by a rather large group of analysts is pretty strong at over 11%. So if these analysts are correct, we could see very high double-digit rates of return going out for the next several years. And even if I look at the long-term trend line growth, it's almost 12%. So Carnival Cruise Line might be one you might also want to take a look at if you're a little more aggressive. And then last but not least would be Taiwan Semiconductor. It's really a Taiwan company. It has a AA- credit rating from S&P. Is not given a sector classification though. Kind of an interesting stock. Earnings growth has been almost 21% a year. You can see that the price has really tracked earnings growth. As I shorten the graph, you can see a better correlation. Normal PE though has been around 16. I think that's important to focus on here. Current PE is 17.3. This is an ADR, I might have pointed out. The company only has 5% debt. As far as looking at forward forecasts, about 11% estimated growth. The company's analyst scorecard has really been what I guess you'd call it exceptional. They've either beat or hit analyst estimates virtually 100% of the time. They've hit them 60% in the 1 year and hit them 80%, interestingly enough, in the 2 years. So this is a very interesting company with a nice high 3.4% dividend yield, a moderate valuation. I'd say the valuation is neither high nor low. Again, if I use the normal multiple calculator, it's on the upper end of my valuation corridor. But it does offer the opportunity to generate some decent rate of returns, and certainly the dividend is currently nice. They have cut the dividend occasionally in the past, but their dividend growth rate has been very, very strong. One negative that I'd like to point out, although the company's operating cash flow, I'm going to get price issues off of here, has covered their dividend very nicely. If you look at free cash flow, which is what's left over after running the business, they actually are not covering their dividend based on free cash flow. Now that does disturb me some, but anyway, I felt it was reasonably valued. It's kind of an interesting stock to look at. This is one I'd be very careful with my research on because, again, I don't like what I see in terms of the numbers. But from an operating earnings point of view, the stock does look moderately attractive. Anyway, this has been Chuck Carnival. Hope you enjoyed this addendum to my previous article where I cover these additional 9 stocks. If you like what you saw here, you can email my associate Polly at the email on this screen, or you can call us on the number. And of course, don't forget to subscribe to our YouTube channel. This is again Chuck Carnival. Thanks for watching.